Welcome back, Invest Info, episode 37. Um, Before I get into the title of this lesson and speak about this lesson, I want to say I'm not a financial advisor. Okay. Everyone's entitled to their own personal decisions, and this is just my current outlook on the market and sort of where I'm going towards investing, right? Um, this topic was fueled by the fact that all these hyper growth stocks, very popular stocks, meme stocks, trend stocks, EV, pennies, all these stocks have pulled back severely. And some have fallen 40, 50, heck, some even 250%. And what is even more, I guess, crazy about the situation is some of these stocks are falling 250% and still 50 times overvalued. So I want to name this one three value stocks that are currently on my watch list slash have exposure to. Right. So the first one I want to start off with is ticker CDEV. All right. This is again a natural gas company, and we all we might not know what happened, but last year stock futures plummeted due to the COVID situation, which created opportunities. Right, as Charlie Munger, Warren Buffett speaks about, different crises create opportunity, and these crises will cause uh, stock prices to unirrationally fall to prices way below their value. And this is I want to use this example first because this stock fell all the way to a penny stock, CDEV, right? So it fell all the way to 87 cents last year. Now the stock is trading at $4.46. So it's up over 1,000% on the 1 year. So let's take a look at the 1 year. Yep, it's up over 1,000 400%, right? And it was one of those stocks that fell bad. It fell all the way from, I believe it was trading its peak. Uh, at its peak, it was above $23. It was above $20, and it fell all the way to 80 cents, even lower actually. And now it's going back. And even though it's went up over the past year, over 1,000%, guess what? The stock is still currently trading well below its value, meaning the company was to liquidate itself, it will be valued more than $4.46 per share. So this is one that is on my radar. Energy. There's a lot of opportunity in energy because with the recent again trend of electric vehicles, solar energy, most retailers uh, didn't stop to look at liquid natural gas, even though the rates of liquid natural gas is going up and uh, energy is energy futures are going up, so we see in certain of these things come back to its intrinsic value. Now, you look at a trend. Let's take cryptocurrency for example, right? If cryptocurrencies 100x in a year or 1,000x in a year, or fall 1,000x in a year, both could be justified because we truly don't know the value of cryptocurrency. Generally, it's not a cash producing asset. It's really just speculation, and that's not what we're here to invest. We should approach investing like how a wholesaler buys products, right? They buy it for less than what it's worth to sell it to somebody else at an additional price, right? So we should be buying things far less than they're worth. Why? To protect ourselves. So when the market pulls back, we're excited about the fall price as opposed to buying hyper growth trends and hoping to get rich quick. When these things pull back and then we look into the value of the business, it still has a lot more room to pull back. So yeah, this is the first one on my list. All right. The current book value they have here, according to Yahoo, is $9.35. When I did the valuation, I got a bit more. Okay. So that's one. Next on my list. This is a stock, Citigroup, ticker symbol C. Now, Citigroup is trading at, let's see, well, it's trading at 70 bucks a share. They don't have it here on Yahoo Finance, but we want to pay half of what it's worth. So if it falls into the $60, $50 range, it's a screaming buy. But also we have to factor in the growth rate, right? Because what it's trading, the growth has a growth rate of 4.30% per year. Also, we see institutional investors and hedge funds like most notable Michael Burry pretty much filled his entire portfolio with Citigroup in forms of call options. So Citigroup is a you can't go wrong often a lot with certain banks. Um, this is a value play. And again, these value plays are not going to be the most exciting. It's just really buying something for less than what it's worth. We're buying $10 bills at $5. That's what investing is, and we're doing it at a safety price. Um, can I guarantee that this will rocket up a month from now, 6 months from now, even a year from now? I can't guarantee anything. I'm just saying I'm looking at certain these stocks that trading below their value, have good growth rate, and I speculate there'll be more in the future. And if I'm wrong, I'm paying far less than what it's worth. And that's what truly investing should be. Really limited our risk to gamble. Okay. And last but not least, a stock that I'm still bullish on, Gaslight Partners. All right. Ticker symbol GLOP. This one is a liquid natural gas carrier based in Greece. And my bullish thesis is still the same. All right. We know that the United States wants to strengthen its allyship with Greece to transport energy throughout the world, really. And Gaslight Partners parent company got bought out by Gaslight got bought out by BlackRock. Most recent earnings at around $5.80 per share. It went private, and that was another company that was undervalued. And I'm still buying this thing. I'm still buying this one. Personal exposure, full disclosure. I have shares of Gaslight Partners. The stock is trading at $2.63. It's still down on the yearly. We see 5 years ago, even when the stock was trading at 25, it was worth 40. $2 years ago. So, again, this is some of the irregularities that we see in the stock market. Stocks trading far below what they're worth. It doesn't mean that it could return back to its book value. Okay, it just means that you're paying. If this company was to liquidate itself right now, it would be worth, on my calculations when I did the valuation, $18 a share. Yep, still trading at 260. So the more it falls, the more I buy, and I don't worry about it because, I'm like doing the value of the business, Again, you can't say that with certain trends and certain stock hypes and these types of things. So again, it's just invest info. So, there's if you understand that something could be worth far more in the future, if you truly understand it, like it could be a penny stock, But if you understand the business, no debt, sometimes the valuation it might be overvalued on a book value per share standard, but growth rate, the growth rate does play a factor. However, we're not doing that. We're doing, if this company was to liquidate itself right now in this very moment, if the stock market was to close, and this company was to have to liquidate, what would it be worth right now? So we want to pay at a margin of safety price. And we do this with several stocks, but this is just three that I'm looking at, some that I have exposure to. And with the market pulling back and a lot of speculative stocks getting pulled back, normally you would be happy and want to buy more of something you understand. But when you look and go into a lot of these companies and realize a lot of them are not even making any money, no earnings, and people are still loading it. Why? Pure speculation. Pure speculation. You just think that it's going to be worth more in the future, but it's not even earning money yet. So I wanted to do this topic to just let investors be careful out there. Understand what you're buying. Don't as hard as it is sometimes, we can't treat this thing like a slot machine or a casino, because institutional investors, which often outbeat the retail investor, even though the retail investor have the advantage. But why do they? Because they have patience. And again, these guys are doing their due diligence before they establish these major positions. In closing, we always speak about the institutional investor that's buying up these particular stocks. And Renaissance, the hedge fund Renaissance, funded by John Simons, I believe, or Gene Simons. Pretty good hedge fund, increased to this position 88%. So that's a good sign. You always want to see institutional buying in the company, and not get caught up too much in price with valuation, because they'll hedge you against times like these. At times like these when uh, things are becoming more and more uncertain, there's a lot more fear, nobody knows what's going on. Our job is just to buy things for far less than they're worth. All right, so that's the three I'm looking at, and I'll see you guys on the next one.